Good morning, folks. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And quite an interesting set of moves have been occurring in the financial markets as we've been talking about. Currencies strengthened against dollar in the past couple of days and then started to pair some gains on it on the backdrop of the awaited CPI numbers for the US today. Now, equity markets were seen dropping in the overnight action, and there was also a whole host of drama on the crypto side with Binance and FTX involved. Now, INR as well opened strong against the USD yesterday and maintained that strength throughout. So, JK, what's your take? What's going on? Whether this strength would continue or what shall happen after the CPI today?
Yeah, good morning, Shikhar. Yes, it's been a day of very less economic data, but lots of other news. Of course, to start with the CPI, it's expected to show a decline in the headline number from 8.2 to 8.0, but market is not taking any chances. They're not assuming any drastic fall. Although some of the components of inflation actually have dropped, like energy prices, as well as the second-hand vehicle prices. They say also that the rentals are started to decline, but it will take some lag effect only. Therefore, the headline number is unlikely to fall too much. Also, I want to point out that the rentals have one of the highest weightage in the CPI index in the US. So we may not expect too much of a drop in the overall index as well. But we keep our fingers crossed, and definitely the trend in the CPI will decide the space at which Fed will go ahead in their rate hikes. Although the discussion now more centers around the terminal rate, currently around 5.09%. But as I said, there are a lot of other news haunting the investors. Actually, the red wave, meaning the Republican sweep, seems to have not materialized as expected, and they are only expected to gain a slim House majority, while the control of Senate looks like it won't be known for some time, with a runoff in Georgia expected. And currently Republicans are on 49, Democrats at 48, and 3 places in Arizona, Georgia, and Nevada are too close to call. So the outcome is much closer than thought, though it may still be a gridlock. However, ability of Republicans to stall the policies will be much weaker than it was expected earlier. So that is something that a market is trying to assess how it will affect the policies going forward. Because if Republicans were to come back, they are not in, or rather, if Republicans to gain more control, they would not allow too much tightening in the financial conditions. They are for strong stock market. And so that would have been positive for risk assets. Now the investors await for the final outcome. Meanwhile, as you said, the crypto world is engaging more attention, perhaps even more than CPI report due today, because the crash in several crypto products in this week, particularly in the Bitcoin and Ethereum by over 20%, driven by fresh investors and skepticism and the soaring sentiment. This has been triggered by doubts about the solvency of FTX, a brokerage which had become a face of the crypto industry. The firm which had been seeing liquidity crunch for over a year, even as the crypto prices were steadily on the decline, was intensified this month when withdrawals exceeded with tokens worth $1 billion withdrawn in one single day. The latest news says that another crypto exchange giant, Binance, who had proposed to acquire FTX to rescue it, has withdrawn from the deal, sending more panic waves across the investors. Overnight, most crypto products have lost at an average of 15% of their face value, and the confidence has definitely swooned. Just to give you a perspective, Bitcoin, the most popular crypto, has lost 28% this month alone and has slid to quarter of its peak at 64,500. At last, with the bitter experience, this class of investors seem to have realized that there is no lender of last resort in the crypto space. The reason I have dealt with in this about this particular financial sector, which normally we don't cover so much, is that there is some implication on the other asset classes, because with the investors losing so much of money in the particular asset class, they are tending to sell more of the risk assets. And that was depicted in the equity markets falling, and other investors going into the safety of the bonds. Therefore, despite a very bad response to the new 10-year issue by Fed yesterday, the yields did not rise too much. In fact, 2-year yields were somewhat lower as well. And as one would have expected, Dow lost nearly 2%, and S&P and Nasdaq nearly more than 2.5%. A 10-year yields slid by 20 basis points from the peak, but again rose after the auction was getting a bad response. The high yield of 4.14 on the 10-year not only is the highest in this tightening cycle, but also the highest since the prior rate hike cycle, which culminated with the Lehman collapse. That's something which is very notable. In another negative development for the markets, Meta, the parent firm of Facebook, said they are laying off 11,000 of its employees. That is 13% of the total, after a steep slide in the digital revenue of the company. It is the first broad-based or broad headcount reduction in Meta's 18-year history, and Zuckerberg's statement shows that there can be more reductions going forward. With these job cuts, Meta will join a slew of other tech companies such as Amazon, Stripe, Lyft, Coinbase, and Apple that have announced layoffs in hiring freezes in the wake of surging inflation and macroeconomic headwinds. Tech sector has actually been struggling all through the year with steep rise in interest rates, having benefited immensely during the low rates regime, and have depicted the first signs of the job market, cooling off, which is what the Fed is watching very closely. The evolving situation in job market is crucial to assess Fed's future moves, particularly if it intensifies, and the terminal rate, which has become the central focus of the markets. Obviously, the job cuts and layoffs will benefit the company because reduction of costs, but for the economy as a whole, unemployment going up will be something that will determine or rather influence the policy of the Fed forward. As per FX, USD was broadly stronger, with dollar index coming up by 0.9% and recovering some of the ground after 3 days of losses. GBP still retaining the status as the most volatile currency, while euro has become a picture of stability, at least in the short term. Yuan has tended to weaken more after 2 consecutive days of big rise in the new COVID cases in China. Oil prices, which is, of course, somewhat additional good news for India, is that it fell 3.5% as US crude stockpiles rose more than expected to levels last seen in July 21. And Chinese growth concerns have further impact on the oil prices to the downside. There has been a general sell-off in the commodity prices, reversing some of the recent sharp gains as risk sentiment took a hit. As a result, commodity-based currencies like AUD, CAD, and New Zealand dollar were weaker. Yen, which has been on the focus in the currency space for quite some time now, once again failed to break the 145 mark, and it repeated strong support seen there gives us a feeling that it may once again move towards 150, particularly if the CPI number comes higher than expected. Rupee obviously had a very impressive run in the last 3 days. In fact, 3 days of gap down opening and good selling seen on upticks also. It has followed the fortunes of DXY for the first time in many months. Fall through 82 closely watched support level has triggered a lot of top sell by exporters, with supply demand now probably slightly in favor of the former. But unless it regains 82, a sell-on rally strategy is likely to be in place. But obviously, we will watch how the dollar index moves from here on and how the Fed policies also evolve. Thank you very much.
Okay, wonderful, JK. And yes, there's a whole host of drama going on, folks, and the cryptos have been having their influence on the other risk assets of the company, risk assets of the market. And yes, the US CPI data that we've been talking about now, it is expected to show some bit of a decline, but it's not too significant as the rentals have not moved much uh, in the immediate term. The midterm election outcomes have been closer than what was expected, but it is still moving towards a gridlock. And what else can we say? A significant amount of layoffs have been going on in the markets, and the latest entrant to that particular trend has been Meta laying off 11,000 people. And with this kind of surging inflation and macro whirlwinds that we are seeing in the economy side, along with so much of layoffs, there's going to be some bit of a question on what sort of macro performance are we heading towards. So folks, risk management continues to be an important activity that we need to carry out with. I hope you guys are managing the same. We shall come up with another round of updates tomorrow morning for you. That's it for today. Thank you so much for listening.